All right, I want to bring in Mark Zandi now. He's chief economist at Moody's Analytics. Mark, good to see you again. I want to start with this jobs data we got today. The number of homes for sale dropping to a record low in January. It caused a big spike in home prices. The ability to buy a home now even further out of reach for a number of Americans. What do you think is going to be the long-term impact of that? And do you see that supply shortage changing anytime soon?
No, it's a real crisis. We have a very severe shortage of homes, so particularly affordable homes at lower price points, and even apartments for reasonable rent, very short supply. And it's a problem that's been developing since really in the wake of the financial crisis and the housing bust. Builders have been very slow to ramp up construction for lots of different reasons, and so we're left with this huge shortfall. And we can see it now in the surge in house prices and in rents, particularly for the types of apartments that people need to rent, not lifestyle rental, but they have to rent. And so it makes it much more difficult for everyone to save for down payments and to afford to purchase a home. And of course, if you are looking for a home, it's becoming more of a stretch. And of course, all of this is happening at a time when mortgage rates are very low. They're off their all-time lows, but they're still historically low. And as interest rates normalize, mortgage rates start to go back up, this is going to become even worse of a problem. So it's a very pernicious problem, and I think it's going to require a policy response to address it if we want to address it anytime soon.
So then, do you think we're looking right now at the formation of some sort of bubble here? As you've been talking about, the supply is low, the demand is high, we're seeing house prices surging.
Not yet. I mean, in my mind, a bubble is when you have a speculation in the market, when you have in the housing market flipping. So people going out buying a home with the intent of simply flipping that home, selling it very quickly to make a profit, thinking that they'll make a bundle if they just buy that home and sell it very soon. This was obviously a very significant problem back in the housing bubble in the middle part of the 2000s, just prior to the financial crisis and the collapse in the housing market. We're not seeing that yet. Most of the buying that's happening now are folks that are buying and they have every intent to hold, either as a second vacation home or as a rental, or they just want to be a homeowner, and so they're going to hold on. So we're not seeing that speculation, that flipping, which would be the fodder for a bubble. But another year from now, if we see prices increasing 10-15%, I think we will start to see markets getting infected by that speculation, and bubbles will start to develop. And even having said that, even though it's not a bubble, it doesn't mean that the market isn't overvalued. Valuations are now very high. Prices are very high relative to household incomes and rents and construction costs, the fundamentals that are key to the value of a home. And so we could see, prices raise here as interest rates rise, or even some price declines in parts of the country where things have gotten really juiced up. So it's not a bubble yet, but it does feel awfully stretched.
Yeah, a little frothy, right? You said a moment ago that you thought we need to have a policy response to this. What might that look like?
Well, I think it has to be a number of different things, because there's not one problem here. There's lots of different problems. The most significant thing is land use. We've seen very significant restrictions by state and local governments on the use of land, the boundaries of where builders can build within urban areas, and even in the areas where they can build, how they can build, how big the property has to be, square footage, how many units can be on the property, parking, various zoning and permitting issues. So I think those things need to be addressed to allow for more construction. And the only way that's going to happen is if the federal government incents state and local governments to change their land use practices. So, for example, there's a big infrastructure package coming, right? And part of that's going to be transportation dollars for state and local governments to go out and fix roads and bridges and broadband and everything else. Tie that money, if you want to get that money, state and local government, then you need to change your land use practices to allow for more affordable construction in your community. So that would be a way to, kind of a carrot to get people to state and local governments to change their land use practices. But, I just mentioned one aspect of this. There are many different aspects of this problem that require, a multifaceted policy response.
You know, Mark, we were chatting a little bit earlier with Tim Courtney, who said that markets right now are looking for the hard data, the proof of the economic recovery. Of course, Alexis mentioned jobs data not too long ago. What are you anticipating this Friday when we have that jobs report out?
Yeah, it's going to be, I think, a big number. I wouldn't be surprised if it's 750,000, a million jobs are possible. Part of that is just a bounce back from the incredibly awful winter weather we had back in February. Remember, Texas shut down for a few days. So we'll see a bounce back, and that'll help juice things up. Also, reopenings. A number of businesses in different parts of the country reopened in March as the number of infections, the COVID infections, started to wind down. And schools are starting to reopen, so we'll see some more jobs in education. And then in the not too distant future, probably as we go into April and May, the American Rescue Plan money, the $1.9 trillion fiscal support package that passed Congress a few weeks ago now, that money's starting to flow in, and that's really going to start to affect the economic data as we move into the spring months. So I expect a few months of million plus. It's going to be very, very strong, boom-like kind of growth in the not too distant future.
And Mark, we keep seeing inflation creeping into different parts of our economy. We're seeing it in food prices, raw material prices, lumber prices have been soaring. Do you think that at some point the Fed's hand is going to have to be moved sooner rather than later? I know the Fed has been saying they're looking at raising rates no sooner than 2024, but do you think they may have to act sooner than that?
Yeah, I'd be surprised if they can hold on that long. I mean, my expectation is that they'll have to start winding down their quantitative easing. That's their bond buying program, probably late this year, certainly by this time next year. And then I think the economy will be back to full employment, 4% unemployment rate or lower by late 2022 or early 23. And that's when the Fed, I think, is going to be under significant pressure to start normalizing short-term interest rates. So, maybe they've got a couple more years to go here before they have to start raising short rates, but I don't think it's much more than that, because I am quite optimistic and increasingly confident in my optimism about the kind of growth we're going to get. And there's more fiscal support coming. We've got the president's going to announce an infrastructure package tomorrow that's going to be large and going to be very supportive of growth, and we'll probably get even more fiscal support after that. So there's there's a big tailwind behind the economy that's going to drive a lot of growth, and I think the Fed's going to have to respond to that sooner, at least sooner than they think they are.
Right. All right. Mark Zandi, Chief Economist over at Moody's. Thanks so much.